Section 5, Ratio Analysis. By this stage, we've learnt about how the basic accounts fit together, your balance sheet, your income statement, the cash flow statement. What we're going to do now is start to understand what some of the numbers are telling us and how we can interpret them. Now, ratios are giving us the link between, a basic ratio is one number divided by another number, and it's giving us a relative size. How big is one number relative to another number? If I say we have receivables of 10 million euros, on its own, it doesn't tell you very much. You need to compare it to something else. And that's what we're going to be looking at. We'll divide them into a few different groups here. We're going to look at liquidity, working capital cycle, and profitability, and then we'll finish with earnings per share. And we'll see that you can interpret the numbers in a range of ways, but the level of information you get from the accounts is enough to get a good understanding of what the business is up to. Let's begin with just defining what a ratio is. It's one number divided by another number. So if I say current assets is so many pounds or dollars or euros, it's less useful than saying it's a certain proportion of another number on the balance sheet. So if I say now, here is a ratio that we've calculated, it's giving us a certain amount of information about how a company's performed. You can get even more information by saying, well, how does that compare to this company last year? Has it got better or worse? And you need to work out whether bigger or smaller means better or worse, depends on the ratio. Is it better or worse than a competitor? Is it better or worse than the rest of the industry? Or is it better or worse than if the company had made a different accounting decision? Remember early on, we talked about the choices managers have, and we're going to talk, there's a whole section coming up on this. If the managers choose to change one of their assumptions, for example, from long asset lives to short asset lives or the other way around, how's that going to affect certain ratios? And we can have a look at that. Once we've understood the calculations, we can do analysis like that. So it's an important skill that we need to be able to use, that we need to be able to apply to the financial numbers. Now, we're going to put on some hypothetical numbers. Don't worry, it's an artificial example, but try and understand how we're doing the analysis rather than the actual mechanics of this company, Hawtrey Inc. So this is in dollars, we're working in thousands of dollars here. You can see that we've got cash, receivables and inventories, PP&E, investments and intangible assets on the asset side, then overdraft payables, a bit of tax liability as current liabilities payable within a year, long-term debt and some finance leases under long-term liabilities. A finance lease is, as we defined it very briefly earlier, you're using an asset and agreeing to pay over many years for it, and it's a long-term commitment, so it's long-term liability. And then that's made up by equity. You've got some preferred and common stock and some retained earnings. And it all balances 3,300 assets, 3,300 liabilities and equity. Do please check that you agree with that. Here's the income statement. Revenues just shy of $6.5 million. You've got COGS, operating expenses, bit of interest, bit of tax, down to net income of $560,000. Now, let's begin with some liquidity ratios. These are what we call pure balance sheet. So we're going to look at two numbers straight from the balance sheet, and we begin with the current ratio. You have current assets and current liabilities, and you read them straight off the balance sheet. All the calculations, by the way, are done here. If you need to check that, do please refer back to the balance sheet and income statement that I've just shown you, and confirm that the numbers are correct and confirm that the calculation is correct. For the purposes of this, I'm not playing with the calculator. I'm simply going to analyze what we use these numbers for. So the current ratio, current assets over current liabilities. Your current assets, remember how we defined current assets? They're items that will turn into cash within one operating cycle. So if it's receivables, we need to collect them. If it's inventories, we need to sell them and collect them. And then your current liabilities, which need to be paid within 1 year. So when we look at the current ratio, you want current assets to be generally quite big and current liabilities to be generally quite small. And therefore, the bigger this ratio is, the stronger this aspect of the company looks. So here we have 1.86. It means that our current assets are nearly twice as big as our current liabilities. And although that may seem quite strong, it's not actually that big compared to a lot of other companies. So 1.86 is close to 2, that's sort of a bit of a bare minimum, but it does depend on the company. For example, we've just done the example Boscombe. Imagine a retail business where all sales are for cash, but all purchases are on credit. Now, we had that in the Boscombe example, but imagine any supermarket chain. If you go into the supermarket and do your weekly shopping, you're paying in cash, or you pay on card and they get the cash from the bank within a few days. If you are selling, let's say you sell tins of cat food to the supermarket, they're not going to pay you for a good month or two. And so they're going to have a lot of liabilities. And the result of that is, for retail businesses, the current ratio may end up being actually a very small fraction. It may be well under 1. And it doesn't mean it's unhealthy. You need to compare it to other companies, compare it to how it was last year, and therefore be able to get behind what the numbers are telling you. So that's the current ratio. In general terms, main headline is bigger is better. Now, the quick ratio, this is also known as the acid test. Now, what this is doing, it's equivalent to the current ratio, but we are removing inventories from the assets, from the current assets. So you've basically got cash and accounts receivable. Now, why are we removing inventories? What this is doing is saying, how much cash do we have available? Now, of course, cash is there sitting in the bank already. Accounts receivable, now, what could we do to those to turn them into cash? Think what accounts receivable represent. They represent our customers who have bought goods from us and who have promised to pay us. So what we can do, we could offer them an incentive to pay. Now, that incentive can be possibly a discount that would normally be agreed up front. It could be we could send them some letters if it's overdue, or you can go to a financing company and borrow using those receivables as collateral. So in other words, if you're owed, in this case, what are we owed? $710,000. It's possible, because they have promised to pay, you can use that as collateral for a loan, and companies will lend to you in order to get over some cash flow issues that you may have. In other words, the receivables represent money that you will get at some point, and given a little bit of tweaking, you may be able to bring that date forward. Now, the reason they're called quick assets is because you can generate cash from receivables fairly fast if necessary. Why has inventory been removed? Well, answer, it's not a quick asset. Think about inventory. How do you turn inventory into cash? Answer, I'm sure you're saying to yourself, you sell it, but that's only half the answer. You sell it and then collect the receivable. Because when you sell it, that turns into a receivable, unless it's retail, and then the receivable turns into cash when you collect it. But the point is, turning inventory into a receivable means you've got to sell it. No one has agreed to buy it yet, and you can't do it in a hurry. So receivables are your customers who have promised to pay you, they just haven't paid you yet. Inventories, no one's promised to pay anything. No one's bought them yet. So inventories are a slow asset. You cannot turn them into cash in a hurry unless you sell them at a very low price. And therefore the quick ratio is a bit closer to liquidity, because you're excluding that slow asset. What do we mean by liquidity? So the overall top definition. Liquidity generally means anything to do with cash. So if internal liquidity is the company's operations able to generate cash. So here, your current assets we've seen will turn into cash at some point. Your current liabilities need to be paid from cash at some point, and therefore these are liquidity ratios. So there's your current ratio and quick ratio, and there's our starting point. Next, we move on to working capital. Now, what's the working capital? Working capital is essentially your current assets and current liabilities. In particular, we're going to talk about receivables, payables, and inventories. Now, receivables are your sales, your customers that haven't yet paid you. Your inventories are goods that you have purchased and not yet sold. And your payables are purchases that you've made but you haven't yet paid for. So let's have a look at these three. We're going to look at 6 ratios here, 3 pairs of ratios, and they're telling us how efficiently we're using our working capital. So think about receivables. You're owed money from your customers. Now here, we're going to look at receivables next to sales. Now, sales and receivables naturally go together as a pair because all sales, unless we're retail, all sales will go through receivables. You make a sale, it's a receivable until they pay. All receivables have gone through sales. Every receivable is a sale that hasn't yet paid us. And so these two go together. Now, if you want a little bit of alliteration, back in my auditing days in the last century, we used to audit these two and they'd be called R and R. So you've got a little bit of alliteration there. Revenues and receivables. So remember, revenues and sales mean the same thing. So revenues and receivables. And they naturally go together because they are the same business process. We're selling goods, we're collecting the money in. Now, the way we can analyze receivables is twofold. First of all, how many times a year do we collect them all in? Now, of course, that's a fairly simplistic statement because you're trying to collect them in all the time. But let's keep a very simple number. Let's suppose you've got $12 million of sales and $1 million of receivables. So just try and visualize that. $12 million of sales, and let's call it $1 million a month. $1 million of receivables. Can you see that means you're giving credit of around a month? If all your customers pay after a month, then you're going to have 1/12 of your year's sales still owing to you at any one point. Now, we can describe this in two ways. First of all, the turnover. How many times a year are we turning over our receivables? Answer in that case, 12 over 1 is 12 times. If you're collecting the receivables once, if every month you're collecting $1 million of receivables, then you're collecting it 12 times a year, and that's called the receivables turnover. The alternative side is basically the reciprocal, and that says how many days outstanding do we have in the receivables? And there's a little acronym here called DSO, Days Sales Outstanding, also called debtor days. And this is saying how many days on average are we waiting for the money? And here it's the reciprocal of the receivables turnovers. If you've got 1 month's credit, then we said the receivables turnover was 12 over 1, which is 12 times a year we're collecting it. The DSO is how many days do your 1 month, your $1 million receivables represent? Answer in this case, it's a month, so it's 30 and a bit days. So your DSO is how many days, what fraction of a year? And it's we've got this times 365 to turn it from a year into days. And so in our example, my previous example, it was receivables were 1 million, sales were 12 million. That gives 1/12 of a year. At any one point in time, we're owed 1/12 of the year's sales. Multiplied by 365 gives you about 30 and a half days outstanding. Now let's put this into context with Hawtree. Your revenues are 6,450, your receivables are 710. You can see we have a turnover of 9. That means, roughly speaking, 9 times a year you're managing to collect in all your receivables. That also means that your receivables represent 1/9 of the year. Now, if you've got 365 days, 1/9 of that is around 40 days. And you can see that 710 divided by 6,450 times 365 gives us that 40 days. So in other words, what this is telling us for Hawtree is our turnover is around 9 times a year, and that our receivables are outstanding for an average of 40 days. So each time we make a sale, on average, it comes in after 40 days. Now, you may be saying to yourself, but surely that's based just on the year-end number. Surely the amount of receivables is going to fluctuate through the year. Absolutely. And we're going to talk about that a little bit in a moment, because also we have a timing issue here. This is what we call a hybrid ratio. And it's a hybrid, this is the Quartic terminology. We call this a hybrid ratio because your sales come from the income statement, your receivables come from the balance sheet. And as you'll see, there's a bit of a mismatch here because your sales are over the whole year, whereas your receivables are just at the year end. And in fact, the word average in here indicates what we're going to do. In this case, we can't do any averaging because we've only got the year end. But what you would do is you take the average of two numbers if you have them. So in this case, receivables turnover, we're using the year-end receivables balance to give us 710, and that gives us our two ratios. So that's revenues and receivables. Let's now do the next alliteration, which is P and P, purchases and payables. Now, these naturally go together as well because your purchases are goods that you've bought from your suppliers. Your payables are those purchases that you haven't yet paid. And so they also naturally go together. Every purchase, assuming you're not working with cash, every purchase that you make is going to go through accounts payable. And every account payable is going to be a purchase that you haven't yet paid. So they naturally tie together. We do the same two ratios. You've got the payables turnover, roughly how many times a year do we clear the payables balance? And you've got the days payable, roughly how many days or what fraction of a year are the payables outstanding. And so purchases over payables, we've got 2,920. Now, in fact, what we're going to be doing, without going into too much detail, this is a topic for another subject. If you come back and do your CFA program with us at level 1, we'll talk a lot more about how purchases and COGS tie together. So your COGS is on your income statement as the cost of goods sold. Your purchases are similar, but they're not quite the same. Now, to put it in perspective, if your purchases and your COGS are the same, then we have a nice stable scenario. But just to differentiate them, and I'm not going to go into more detail here because it really does take us a step far beyond this course, your COGS are the cost of the goods that we sold during the year. Obviously, that's the name. Your purchases are the cost of the goods that we bought during the year. They're both at cost, and so they are comparable to each other, but purchases is what we bought, COGS is what we sold. And if the inventory levels remain constant, then they will match. If inventories have gone up in the year, it means our purchases exceeded our COGS. Obviously, we bought more than we sold. But that's a topic, I'm going to stop there, that's a topic for another course. But what we're saying here is purchases and payables naturally go together, making our assumption that purchases and COGS match. Your purchases are 2,920, get that from the COGS on the income statement. Your payables are 480, and so here you've got 6.08. What does that mean? That means we're turning over payables 6 times a year, which means roughly every 2 months we're paying all the balances. And that is confirmed by saying that days payable, which is payables over purchases times 365, is our 60. So 365 days in a year gives us 60 days of payables. So you can see these tie together. We're paying our supplier invoices roughly every 2 months, or roughly after 2 months per invoice, and therefore at any point in time what is outstanding is around the last 60 days of purchases, which means we have a turnover of payables of around 6 times a year. Now, the last one doesn't have the alliteration. We had revenues and receivables, purchases and payables. The last one is COGS and inventory. Now, these two also go together. Now, they don't go together perfectly, but they're as good as you can get. The reason they don't go together perfectly is COGS is the cost of the goods that we sold, whereas inventory is the cost of the goods that we haven't sold at the year end. Think what inventory means. It's what's in the balance sheet, what's sitting in the warehouse at the year end. So they don't quite go together. There's a bit of a timing issue here. But COGS and inventory, we can still do the same two ratios to get a rough idea of this. And this is saying how much inventory do we have on us at any one time? How many times a year do we manage to sell it? So in this case, COGS over inventory, if we have COGS of 2,920 and inventory of 450, this means we're selling inventory 6.5 times a year. So think of the inventory balance that we've got, we are selling that amount of inventory roughly 6.5 times a year, which means it's taking us less than 2 months to sell it. And that you can see, this last acronym here is DOH, days inventory on hand. It's not do, it's days inventory on hand, and it says how many days of inventory do we have, how much, so the inventory that do we have, how many days of COGS does that represent? And in this case, because the turnover was just over 6.5, it means our DOH is a bit less than 2 months. So here you can see it's 56 days. That means on average, from when we make a purchase, we've got the inventory for 56 days before we make a sale. And so those two also go together. Note the links between them. So DOH, we're talking about inventory. If you've got inventory that is, let's just do two extreme scenarios. One scenario could be maybe, let's say, a pizza shop. You're running a pizza business, you get inventory in, the inventory is the food, it's the cardboard boxes, and you're getting rid of it in the matter of days because you need most things to be fresh. So there, your DOH would be a small number of days, and your inventory turnover will be a very big multiple. Let's say you're doing it in a week. Your DOH will be 7 days and your turnover will be 52, which is enormous turnover, very rapid turnover of inventory. If we're, let's say, building a ship or building a house or building a large construction that's going to take 4 years, then your turnover is going to be absolutely tiny. It's going to be less than a year. It's going to be less than once a year. And so let's say we're building a ship, and that's called our inventory, and we own that for 4 years. There, your turnover may be literally 1/4 of a year, and your DOH may be 4 years. That's another extreme. So it depends on the industry. Once again, for all 6 of these ratios, on its own, the number means a lot less than when we can compare it to another company or to this company last year or to different accounting assumptions that we can make. So those are our 6 working capital ratios. Now, here we have our note on these hybrid ratios, and we've said there's an issue on timing. Imagine we've got growth in sales. Let's just draw a little picture here. So I've drawn a little diagram here, and we're comparing the sales. So here are all the monthly sales for the whole year. So those sales represent all 12 months. And when we're looking at, let's say, accounts, let's say we're looking at days sales outstanding and receivables turnover, we're comparing the income statement number, which is sales, to the balance sheet number, which is accounts receivable. Now, let's go back to my initial example where we have about a month's credit. What that means is if we consider December last year and we consider December this year, what you can see is your accounts receivable is going to be roughly the last month of sales. And so if we're going to compare the two, in my initial example of 12 million sales, 1 million receivables, then that means you've got a month's credit. But here you can see that we have growth in the year. I've deliberately drawn this growing. And you can see that if you use your year-end receivables, your accounts receivable represent more than 1/12 of the year's sales. If you use the start of year, your accounts receivable last year represents less than 1/12 of the year's sales. And therefore you've got this timing issue. To put it simply, if we were to calculate the receivables turnover, which is sales over receivables, because receivables is bigger than 1/12, your turnover will be calculated as less than 12, even though it should be 12. If you calculate your DSO, your days sales outstanding, instead of being 30 days, it'll be more than 30 days. Again, because your receivables is more than 1/12 of your year. Now, you can see this distortion caused by the diagram that I've shown you here. The way to get around it is you take your start of year balance sheet, your end of year balance sheet, and you take the average of the two. Now, that gets rid of a lot of the impact of this growth. It's not perfect. Ideally, you take your receivables balance for each of 365 days and you take the average of them. But look, we don't have that information. Maybe if you're internal within the company, you can work that out. But if we're external analysts, we're reading the accounts, we're trying to understand what it means, all you have is what has been published. And so here you can work with the two numbers. You get rid of a lot of the difference in timing by taking that average, and therefore when we have the hybrid ratios, the average will give you a better view of what the ratio should be, of the proper economic value of the ratio. So when we did the liquidity ratios, current ratio and quick ratio, it wasn't an issue because it was this balance sheet's current assets, the same balance sheet's current liabilities. When we deal with these hybrid ratios, the last 6 we've seen, you need to take the average for the balance sheet, and that's to make it a better, a more appropriate calculation, getting rid of some of the timing issues. And so therefore, when you see these ratios, most likely the balance sheet item, it'll say average. Hence your receivables turnover is going to be sales divided by average receivables. And all 6 of those ratios, your balance sheet component should be averaged. Let's put those 3 pairs into a diagram and just focus on the days. So inventory is going to be DOH. Receivables is going to be DSO, days sales outstanding. And let's now just have a look. I'm going to follow a transaction. Through a life cycle, if you like, the transaction life cycle. And we're going to start off with the purchase. We buy an asset. And this asset is part of inventory. So we buy some inventory. This inventory has an asset and a liability. Now the asset is the inventory. The liability is the account payable. We haven't paid for it yet. So let's follow through the asset and the liability separately. So we've bought some inventory, and that's the beginning of the timeline. It sits in inventory for how long? Answer, DOH. Now for DOH days, it's in inventory up until this point. What happens there? That's when we make the sale. So we hold inventory for DOH days, days inventory on hand. Then we make the sale and the inventory turns into a receivable. It sits in receivables for DSO days, and then you get the cash. So there's your cash received, cash in. Now, go back to the transaction again. We bought some inventory. Now we owe our supplier some money. It's an account payable. That is going to sit in payables for days payable, and then at the end of that, we pay the cash. And so what this is showing is that we are, in this diagram, we are paying for the receivables earlier than we are receiving cash on sale. So the cash is paid before cash is received. Now, of course, it depends on the exact numbers. For Hawtree Inc., for example, you've got DOH of 56. So here we've got 56 days. You've got receivables, so DSO of 40. So you can see we're getting money in 96 days after we purchase the inventory. That's quite slow, but we're not paying until 60 days after we purchase in inventory. And so overall net is 36 days. Now that 36 days is quite important for a business, because although the number that we get in is bigger than the number that we pay, assuming we're trading profitably, the cash received is bigger than the cash paid, because on sale you're making a gross profit. What we're doing is you've still got to survive the 36 days. So imagine you're running a small business, you've just started up, and you're struggling for cash. You know that even if you're profitable, you are going to have to pay your invoice in 60 days, but you're not going to get any money in for it for 96 days. And so you've got this 36 days that you have to be able to survive without that money. And that is very, very harmful. It's cash management that causes most startups to fail. Now, this business may fail if it doesn't have enough cash to survive those 36 days. Now, that's a fairly damaging thought, but that's the state of this. But you need to analyze this in terms of how the company is doing, how it did last year, how other companies are doing. And let me just give you a different view on life. Let's imagine that we are a retailer. Think about a supermarket chain. How much inventory do they have? Now, if you take your big supermarket chains, inventory costs a lot of money. You've got to, once you've bought it, it's sitting in warehouses going off. So if you've got fresh food, for example, you don't want it there for any longer than you have to. So inventory comes in, you immediately distribute it to different shops, and it's sold as quickly as possible. So with a large supermarket chain, the inventory is going to be maybe 1 to 1.5 weeks. No more than that, because you just don't want the inventory sitting there. You want to turn it over. What about receivables? Do you owe a supermarket any money? Of course not. You go in to buy your lunch, to buy your sandwich at lunch, you pay them for it. Yes, so receivables for a retail outlet is very small. It'll be a few days because it takes the bank a few days to pay them. But if you've now looked, so if you look at the top, your DOH is maybe 7 to 10 days. Your DSO is just a handful of days, a fraction of a week. What about payables? So go back to the example, you supply cat food to a supermarket. When are they going to pay you? Answer, maybe a month or two. So suddenly your cash conversion cycle is reversed, is negative. So that means if you're a supermarket, you get the money in from having bought inventory, put it on the shelves, sold it, and got the money from the bank. Ages, maybe a full month before you've actually had to pay for that. So it's a negative cash conversion cycle. Cash comes in before cash goes out for it. And it's a very healthy position. Now, let's go back to a supermarket chain. We talked about the quick ratio. Let's do the quick ratio for a large supermarket. Inventory, we've removed anyway, but it's not that high. Cash is generally a fairly modest amount. Receivables are close to zero. Payables are enormous. So if you look at the quick ratio of a retail business, it's probably going to be a very small fraction of 1. It's going to be between 0 and 1, and it's going to be much closer to 0. So in other words, it looks on the face of it very unhealthy. But let's just imagine a supermarket chain. Take Tesco. They have if you look at current assets and current liabilities, their current liabilities are bigger than their current assets by quite a few billions of pounds. Now let's just think about that. Those billions of pounds Tesco owe their suppliers. When are they going to pay them? Well, they're going to pay each invoice after a month or two. Yeah, and I'm sure Tesco will pay their invoices according to the terms they've agreed with their suppliers. But by the time they've paid each invoice, they've got another invoice. So in other words, the accounts payable on Tesco's balance sheet is permanent because each invoice will go along the conveyor belt and be paid, but they've bought more cat food by then. So by the time they pay you for the cat food you supplied, they've bought another month or two of cat food. So they have got this current liability called accounts payable, which is billions of pounds. First of all, when are they going to have to pay it? Answer, never. Never, because unless the business shrinks, that payable will stay there indefinitely. Second question, how much interest are they paying on that? Answer, nothing. So basically, you've got this scenario where a supermarket chain has got billions of pounds of liabilities which have been provided very kindly by their suppliers. They are never going to be paying off the balance, and they're never paying interest on it. What a fantastic situation is that? Now, on the face of it, your current ratio and your quick ratio are quite low, and if you look at it in isolation, you may say that looks quite dangerous. But no, quite the opposite. In that case, you can see that in fact, it's quite a healthy position to be in. You've been lent billions of pounds indefinitely at no interest. Fantastic, take me there. Let's move on to profitability ratios now. Now, these are pure income statement. And what this is saying, we're talking about profit margin. A margin is what percentage of a certain figure do we have as profit. Now, in all these cases, it's a percentage of sales. Now, work your way down the income statement. If you think about the income statement, you've got sales minus COGS equals gross profit. What is that gross profit as a percentage of sales? Minus operating costs. Then you've got operating profit. What is that operating profit as a percentage of sales? Then you've got minus interest, and you get to a pre-tax profit margin. You pay tax, and you've got a post-tax profit margin or net profit margin. So any point where you're showing profitability in the income statement, you can work out that as a percentage of revenues, and that is your profit margin. Now, you'd expect it to be decreasing numbers as you work it down because you're subtracting expenses as you go. So in this case, your gross profit margin, we had revenues of 6,450, we had COGS of around 3 billion, so gross profit of $3.53 million, and therefore our gross profit margin is around 55%. In other words, every widget that we sell, if we're selling something for $100, it cost us around $45, and so we've got gross profit of $55. That's how you interpret this. After our operations, you got $13.20 left from your 100 of sales because you've got operating costs that have reduced the gross profit from 3,530 down to 850 operating profit. And then after interest and tax, you're down to 560. And so here it's 8.7%. This means if we're the shareholders, your net profit is 8.7% of the revenues. So all three of these, you'd expect it to be decreasing because you're subtracting expenses as we move down the income statement. You're saying at each point, it's a percentage of your sales. And the further down you go, the smaller the percentage that you'd expect. Now, these are all useful in their own ways because your gross profit margin is saying what is your gross profit markup? What are you selling goods for? What are you paying for these goods? Your operating profit is saying, well, how productive and profitable is the functioning of your business? And then your net profit margin is saying, well, what percentage of sales have you got available to return to your shareholders? So they give you different information. And so those are your three profit margins. I also mentioned your pre-tax profit margin. So there's a fourth one. But there you can see the calculations, all very straightforward. It's literally what percentage is this of sales. There's no hybrid here. It's all pure income statement. And just as your current ratio was balance sheet over balance sheet at the year end, here we have income statement over income statement. There's no timing difference because the numerator and the denominator both represent the figure for the entire year that we're analyzing. We conclude with earnings per share. Now, this is a very useful ratio that is published with every income statement. So earnings per share is saying what profit is available for each share of common stock. It's a very useful measure for shareholders. If you own 100 shares and you know what EPS is the profit for one share, and so you've got the profit for you is going to be 100 times that. Now, the calculation is roughly as shown on the screen. So it's your profit divided by number of shares that the company's got. So if you're going to work this out, you've got to think about what complications there could be. One complication is what if there are preferred shares? Now, we're doing this from a common shareholder's perspective. Now, on your balance sheet, we've already discussed your preferred shares get priority, hence the name, over common shares. And so for working out earnings, you've got to have paid your preferred shareholders first. Hence, the earnings are net of preferred dividends. So your numerator of this equation is net income minus preferred share dividends. And then that's then what is available to common shares. Your denominator, the bottom of the fraction, is how many shares are there in the year. So weighted average number of shares. Again, the complication here is what if the number of shares goes up or down in the year? Answer, you need to do some adjustments. We're not doing that here, but this has the potential for being quite a complex calculation. The basic definition is straightforward. What profit did the company make for common shareholders? How many shares of common stock were there? Therefore, divide one by the other, and it gives you the amount of profit for each share. Now, EPS is extremely useful on its own, but it's also useful in conjunction with the share price. Now, this gives us the PE ratio. So your PE ratio, or P over E, your PE ratio is the share price divided by the earnings per share. Incredibly useful also for analysts, for shareholders, because this is saying how expensive are the shares? How many times this year's profit do we pay for the shares? If, let's say, your earnings are £1 and your share price is £10, then you're paying 10 times this year's profit for those shares. If it's a very big number, you may argue that is an expensive share. Let's say the earnings is £1 and the share price is £40. That looks very expensive. So on the one hand, why are we paying £40 for the share? On the other hand, you could say, well, in fact, it's high because we think that profit's going to grow. So although earnings are £1 this year, you may have a very high PE ratio because we're expecting earnings to grow a lot next year. The other side, let's say the PE ratio is very low. Let's say the share price is only £5 and earnings is £1. So first of all, it's very cheap. If you pay £5 for a share, you're getting that back in 5 years of profit. But part of the reason it's cheap is because maybe we think the company is about to do very badly. Maybe we think this company's had a really difficult year, and although they've got that £1 earnings per share, we think it's not going to be sustainable next year. So again, lots of information in our PE ratio. The PE ratio is a very useful measure when we're doing equity analysis, when we're doing equity valuation. Please do come back for other Quartic courses. We do go into this in much more depth. There's a lot to analyze here. So when we talk about EPS, I've already described a slight complication in terms of the calculation. First of all, on the numerator, you're subtracting the preferred dividends. On the denominator, your weighted average number of shares. If there's been a change of shares in the year, you need to work out some kind of weighted average. But there are other complications as well. For example, when we talk about convertible bonds, I'm not getting into the detail of convertible bonds, but in a simple form, a convertible bond is the company has borrowed money by issuing a bond, and the bondholders have the right to convert that into shares. Now, if you're a shareholder and you've just worked out EPS, you need to think, well, that company may have 1 million shares in issue now, but what if that bond converts to shares at the end of the year? Then you need to think that may have a dilution impact on our earnings per share, because if a convertible bond converts to shares, there will be more shares in issue. And that's called a complex capital instrument. And when we deal with that, your earnings per share may be affected. What the answer is, what you do is companies actually have to publish 2 earnings per share figures. One of them is your basic earnings per share, which ignores things like convertible bonds. And the other one is what's called your diluted earnings per share, which is the worst case scenario. If these bondholders do convert, is that going to make our life worse? If so, let's publish that figure as well. So that's a bit on earnings per share. Very useful ratio. You're going to see it quoted now, you know the term. Earnings per share and the price earnings multiple, you're going to see all over the place. And if you read the financial press or financial articles, you'll see it referred to very often indeed. So there we've seen a wide number of ratios, very useful when analysing the accounts of a company.